Okay, I want to talk for a minute why most banks require people to make a 20% down payment on their home. This isn't exactly part of the mortgage project. It's just a little extra information to help you understand a little bit more about buying a home. So this has to do with this idea of equity, if you've ever heard of that term. And so let me explain that first. The equity is actually the value of your home minus the remaining principal on your loan. Okay, and that's considered an asset. So if you have equity in your home, that's considered one of your assets. Okay, so let me just give you an example. Let's say the value of the home is, we'll say, $150,000. And you've had it for quite a while. You've been paying on the loan. And let's say your remaining principal, we'll say that this is, the remaining principal, we'll say, is 80. You still owe $80,000 on the loan. Okay, so then your equity on the loan here is going to be the $150,000 minus the $80,000, and so you would have $70,000 equity in your home, and that would be considered an asset. This would be one of your assets. Now, this wouldn't be considered like a liquid asset because you couldn't just take this and turn around and start spending it. So in order to actually liquefy this money so that it's spendable, you would have to sell your home for what it was worth, for $150,000, and then pay off the $80,000 you still own, and then you would have like $70,000 left over, and then that would be actual money that you could spend, right? Okay, so this is important here, okay, because let's say you didn't have any equity in your home. So let's say you bought a home for $150,000, and then maybe a half a year later you had to move. You had to change jobs, you had to move, and you had to sell the home. Okay, well, you would still owe, after a few monthly payments, you would still owe like $149,000 on your home, right? You would owe that amount, but you could only sell it for $150,000. You'd have like $100,000, if that amount, left over, which is not much equity, and it would not be enough equity in order to fix up the home, or to pay a real estate agent, to pay closing cost on the loan. All of that takes, $5,000 to $10,000 to turn around and sell the home. And if you have to really fix it up, it takes a lot more than that, right? So you would be paying money out of your pocket if you had to do that, if you had to turn around and sell the loan. Okay, so now let's say a bank lended you the money and you defaulted on your loan, and so you couldn't pay the loan and the bank had to take the house away. Now all of a sudden they're left with a house, and in order to sell the house, they're going to have to pay money out of their pocket, right? They will be the ones that have to sell the home, and they're going to be paying money out of their pocket for a real estate agent, fixing up the house, closing costs, all of that. And a bank doesn't want to have to do that, right? So what the bank is going to do is they're going to require you to get private mortgage insurance. So if you have no equity in the home, or what they say, they want 20% equity in the home is what they would like. So they're going to require you to get, they call it a PMI. So if you've ever heard the term a PMI, this is what it's referring to. And it stands for private mortgage insurance. And so this is insurance that doesn't actually, you will be paying for it, but it doesn't actually protect you. It protects the bank, so that if you default on the loan, then the private mortgage insurance then will make sure the house, they can turn around, sell the house, and not have to spend money, not have to use money out of their own pocket in order to do that. It's going to insure the bank. And so that is why they require a 20% down payment, because then if someone defaults on the loan, there's already 20% equity in the home. That's enough to fix up the home and turn around and sell it without having to take any money out of their own pocket. Okay? And so let's say you do get private mortgage insurance and buy your home. At some point, you are going to have 20% equity in your home, where this amount over here, like the $70,000, that's almost half of this. So that would be like 40% equity or whatever. So let's actually figure out what it is. So 70,000 over 150,000. Let me get my calculator here. So 70,000 divided by 150,000. This is like 0.46 repeating or whatever. So this would be like 46.7% equity. So here you would definitely have 20% equity in the home, right? So if you have to get private mortgage insurance, you don't have a 20% down payment. At some point, this number divided by the value of your home is going to be 20%. And once you hit 20%, then you can drop your private mortgage insurance. So you need to be aware of that, though, and you need to be looking out for it, because most banks don't necessarily drop it automatically. They're going to wait for you to know that you no longer need it, and then you are going to have to call the private mortgage insurance company and drop the insurance. So it's good to be aware of that. You don't want to keep on paying your PMI when you no longer need to. Okay? So that is the idea behind why a bank would require someone to pay a 20% down payment in the home. It also helps you understand this idea of equity, which is a really important idea when you're buying a home. Okay, and this idea of private mortgage insurance, which you do not want. So if you can make a 20% down payment to begin with, that is a very good deal.